We'll review our 2021 paper. Question number 1. We have been given the following trial balance. And the additional information is that the closing stock as of 31st March 2022 was 8,000. Included in the insurance was 500 relating to the month of April 2020. And the company policy is that depreciation of fittings and fixtures is at 10% on cost. And included in the accounts receivable balance of 18,000 is unrecoverable 3,000 bad debts. At the end of March 2020, we have 250 owing in respect of water expenses. And the provision for bad and doubtful debts increased by 900. So explaining the adjustments. So 800 is simply our stock that we're remaining with at the end of the year. So this stock is factored into two. The trading account where we subtract from our net purchases to calculate our cost of sales, which will help us calculate the gross profit. This also appears in the balance sheet in the current assets because this is our money. The 500 is a prepayment of insurance, meaning this amount we have not enjoyed, we subtract it from the 2,000 to remain with 1,500. Adjustment number 3 is a depreciation calculation of 10% on cost. So the calculation that we have here, 10%, the cost is 30,000. So meaning we're going to charge at 3,000 as an expense in our profit and loss account of the income statement. The same 3,000 will be added to the 10,000 as part of the accumulated depreciation in the balance sheet. However, if we were taught to calculate 10% on reducing balance, what we would have done is firstly subtract 30 minus the 10,000 to get 20,000, and that's when we factor in the 10,000. So meaning we'll be calculating 10% of 20,000, which is 2,000. So you need to be careful when it says on cost and when it says on reducing value. On cost, I repeat, is 10,000 directly on this amount of 30,000. But on reducing value, we first subtract 30 minus 10,000, which is a depreciation accumulated as at this moment, which is 20,000. So 20,000, 10% of 20,000 is 2,000. Such that if we're going to post this into the balance sheet, we'll have 10,000 plus 2,000, which is 12,000. But as it is, it's just a direct percentage on cost of 10%, which is 3,000 plus 10,000, which is 13,000. Is that clear? Then a debt of 3,000 was included in the accounts receivable. So this guy, we need to subtract this 3,000. Of course, this 3,000 will also be charged as an expense. So this 3,000 is recoverable. On top of this, we also need to remove a 900 because our provision for doubtful debts increased by 900. On top of that, we already have provision for doubtful debts, which is 5,000. So we need to adjust that. So these are the adjustments that we need to take account of. All right. Any questions so far? Are we together? All right.
Yeah, Collins, so these adjustments are supposed to record them somewhere in our answer sheet, or
Yeah,
can make adjustments outside the answer sheet.
you
We
need
just
to
prepare the financial statement.
make the preliminary calculations unless you just want to write on a piece of paper and not submit them. But yes, you need to show these adjustments. All right. So are we together? So I have selected a number of questions for the pamphlets that would be relevant because the document is too big. So in my income statement, what do I need now? Let me just show what I did here. Okay, so as you do your posting to the trial balance, Okay, the income statement. So I just want to finish all the adjustments. So now we can go. So our sales figure is here. We put the 9,300. This is obvious, no problem. Then we calculate the cost of sales. So opening inventory, 15,000. We add purchases. This is 6,000. Okay. The total is what? Our total purchases is 75,000. We less closing stock of 8,000. So this is our cost of sales, 67,000, which we subtract from there, and 3,000 to get our gross profit of 26,600. Then we go to our insurance. We see how insurance changed from 2,000 to 1,500 because we subtracted the 500 prepayment. Office expenses as they are, 15,000 salaries, 25,000 bad debts written off, the 3,000 increase in doubtful debts, 9,000 depreciation was the 10%. Do you know where those are coming from? All right. Then water expense, this was 250. This was an accrual, and the 500 here was a prepayment. Okay. The prepayment was what? 500. The one we subtracted. Do you understand where we're coming from? So when we less expenses, we get a net loss of 2250. And we go to our balance sheet, our non-current assets, our fixed assets and fittings, 30,000, we subtract the 13,000. So our net book value is what? 17,000. So we go to our current assets. Our current assets, 18,000 was our data, so trade receivable. We remove provision, which is 5,000 plus 900, which is 9,000, 5,900. All right. Then on top of that, this will give us our, when we subtract 18,000 minus 5,900, we get our net receivables as 9,100. Then we go to our prepayment of insurance was 500, cash at bank was 1,200, cash at hand 400. So our total assets we add, so we have this total current assets is 19,200. So we total up 19,200 plus the 17,000. All right. So this is going to be 36,200. Are we together so far on our total assets? So our accounting equation should be assets should be equal to what?
Capital plus liabilities.
Yes, so our assets were done already. This is 36,200. So let's go now to capital. Capital, we start with finance by what? By equity. Our share equity was what? 30,000. We subtract the net profit of 22,050. Then we calculate it here. So once we get the net profit wrong, we also affect our answer here. So this 22,050 is what comes here. Are we following? Are we following? So meaning our total equity will be what? 9,000, 7,950. So we are here. So capital is what? 9,000, 7,950. Then we add the current liabilities, which include the short term and long term. Short term being the current, long term being the non-current. So here our accounts payable, 13,000. So we add the water expense that was accrued, 250. So we have 13,250. Then other long-term liabilities that we have. Do you have any non-current liabilities? Yes, we have a long-term loan of 15,000. When we add these two, we're getting a total of 15,000 plus 13,000, 250. So the total here we're going to have is what? 36,200. So that's 6,200. So when you add this is 13,250 plus 15,000. Okay. 15,250 plus 15,000. This is about 28. What do we get when we add this to? This plus that. It's about 28,250. All right. Our liabilities. Okay. 28,250. So when we add 28,250 plus our capital, we're going to get 36,200. So meaning it has balance. The goodness with accounting is that all entries will give you a mark allocation. So this amount here will balance with this amount. So the calculations here, I put the note. Provision for doubtful debts is this. Debt receivables is this. Okay. So I think that is that. Okay. Is that clear? So we end here. So the structure of the pamphlet is that I've put some theory questions together, the CVP, the NPV, as well as the bank final accounts. Okay. So our next class will be at 8 hours. I'll go to management theory and practice. This is a request. Management theory and practice.